Welcome back to the deep dive. Our job is to take complex structures, pull them apart, and give you the clearest understanding possible.
And today, we are really getting into the financial engine room.
We're diving into the world of portfolio management services, what everyone calls PMS here in India.
This isn't your everyday investment. This is specialized wealth management.
And it's governed by some of the most stringent regulations SEBI has in place. So we're going to be decoding those rules and requirements using the mandated foundational material as our map.
I think this is a really crucial dive for anyone even considering this level of, customized financial management.
Right.
Fundamentally, everything we're going to talk about today revolves around one single mission.
Okay.
It's about selecting and managing assets to optimize those two critical and often opposing forces in finance.
Minimizing risk while maximizing return.
Exactly. That balance, that trade-off, that's the whole job description right there.
So the portfolio manager.
Yeah.
What's the official definition?
The regulator defines them as a body corporate. So a registered, legally distinct company that enters into a contract to advise, direct, or, personally handle the management of your funds and securities.
Okay, let's unpack this right from the start because the history here is actually really telling.
It really is.
The regulation for PMS in India is, well, surprisingly old. It all started way back in January 1993. That's when SEBI issued the portfolio manager's regulations. And that date, it's not just a footnote, is it? It reveals a lot about their priorities.
It's absolutely fascinating. The fact that it's 1993, what's so incredible about that is that the regulation of this highly specialized, very individual sector actually preceded the full regulatory framework for mutual funds in India.
Wow, I didn't realize that. So they regulated this before they fully tackled mutual funds.
Yes. Mutual funds as a collective investment vehicle for the masses came later. It shows you that the regulator, right from the start, recognized this critical need for strict oversight over entities managing large, often complex, individual client portfolios.
So it wasn't just about protecting the small retail investor.
Not at all. It was about ensuring the integrity and the confidence of the entire high-stakes wealth management ecosystem right from its earliest stages. It just signals that this sector has always been held to a much higher standard of trust.
That sets the tone perfectly. So for you, our listener, here's the roadmap for today. We're going to explore the 3 different types of services, basically the different degrees of control a manager is allowed to have.
Then we'll get into the really stringent entry requirements.
Exactly. What does a firm need to do to even get registered with SEBI? We'll focus on why those high financial and personnel standards are even there.
And finally, the part everyone wants to understand.
The fees. We're going to conquer that often confusing world of fee structures, paying special attention to performance fees and the crucial investor protection mechanisms built into them, like the high watermark principle.
Right. Let's get into it.
Okay. To kick off our dive, we need to understand the playing field. Who are the players and what are they actually putting in the portfolio?
Well, when we look at the entities offering PMS, the sources point to 3 major types.
Okay.
First, you have the big financial institutions. Think of the major brokerage firms and the large asset management companies, the AMCs, that run mutual funds. They often have a whole PMS division.
And the second type?
Then you have the smaller, much more specialized firms, the boutique or independent PMS houses that really focus on niche strategies.
Right, so you have the giants and the specialists.
Exactly. And no matter who the provider is, the scope of what they can manage is incredibly broad. The product class just defines the underlying assets they're dealing with.
So what can they manage? Is it just stocks?
Oh, no. A PMS can specialize in almost anything. You've got your equity-based PMS, of course, but also fixed income, so bonds, there's commodity PMS, and even mutual fund PMS.
A mutual fund PMS? What's that?
That's where the manager's job is to curate and manage a whole basket of different mutual funds for you.
Ah, I see. A fund of funds, but personalized.
In a way, yes. And I think the most common approach you see today is the multi-asset-based PMS, which, blends stocks, bonds, gold, other asset classes together.
And as a client, you're not all just thrown into one bucket.
No. The portfolio managers are permitted to classify their clients, maybe based on net worth or specific investment goals.
Which makes sense. It allows for different service levels. And given how individual this is supposed to be, that seems practical.
Absolutely. But now let's get to the real core of the relationship, which is all about the level of control and responsibility.
Here's where it gets really interesting.
Yes, and this is where we can bring in that analogy that makes it all so much easier to digest.
The personal chef.
Exactly. Thinking of the portfolio manager as your personal chef. The contract you sign defines whether they're a full control chef, a client-directed one, or maybe just a recipe provider.
So let's break that down into the three main service types.
Discretionary, non-discretionary, and advisory.
That analogy just perfectly illustrates the dynamic. Let's start with the one most people probably think of when they hear wealth management. Discretionary services. The full control chef. This is the true hands-off model for the client, right?
Yeah.
The definition says the manager exercises any degree of discretion over the investment of funds.
Any degree, that's the key phrase. Once you sign that mandate and agree on the big picture strategy, the manager has the keys. They have the full authority to act.
So in a discretionary setup, the manager is treating my funds individually.
Individually and independently, yes. They'll usually use a pre-existing established investment strategy. The official term is an investment approach. Or they might create a totally custom one just for you.
But the key is, once that's set,
Once it's set, the manager makes every single tactical buy, hold, and sell decision without needing to call you first. They're making all the day-to-day choices.
the ingredients, the cooking temperature, the timing.
Exactly. They're running the kitchen.
Now, here's a crucial regulatory point we have to highlight. Because on the surface, this looks a little bit like a mutual fund, doesn't it?
It does. The manager is deploying capital across multiple securities.
So SEBI has a very firm rule here. Discretionary management must be handled in a way that does not partake of the character of a mutual fund.
That phrase is pure regulatory speak for it has to stay individualized.
Right.
It reinforces the fact that you, the client, you have your own separate account, your own specific stocks and bonds, and your own specific tax situation. It stops the manager from secretly running a mass market pooled fund without all the strict rules that come with an actual mutual fund.
It preserves that customized one-on-one nature of the service.
Perfectly put.
Okay, so let's move to the second kitchen. This is the non-discretionary service, the client-directed chef.
This is where the manager manages funds only in accordance with the client's directions.
So no buy or sell discretion for the manager.
None at all. This completely flips the control dynamic.
How did that work in practice?
Well, the manager still provides all the professional expertise. They do the research, the market analysis. They might come to you and say, based on our models, we strongly recommend buying these 3 infrastructure stocks right now.
Right.
But the final critical decision on what to buy, when to buy it, and how much to buy rests entirely with you, the investor.
So it's a partnership, but I have the final say. A veto.
A very strong veto. The portfolio manager's role here shifts from being a decision maker to being a highly sophisticated executor.
They only press a button when I say so.
They'll only execute that trade once they have your explicit informed consent. This model is often preferred by investors who are, highly experienced themselves. Maybe they run a family office, but they want the infrastructure and research access that a big PMS house provides.
They keep the strategic power.
They do.
Okay. And that brings us to the third type. Advisory services.
The recipe provider.
The recipe provider.
Yeah.
I like that. So here, the manager steps back even further.
Dramatically. Their whole function is just to provide non-binding advice, research, and suggest investment ideas. They're giving you the blueprint, the market insights, the research papers.
So the key difference is, here, I'm the one not only making the decision, but also executing the trade myself.
Yes. You take the decisions and you execute the transactions, often through your own brokerage accounts. You're basically just buying their intellectual capital.
Why would a large investor do this?
It's often used by big institutional clients, say a global pension fund. They might have their own internal execution teams, but they need specialized on-the-ground expertise. So they hire a PMS house as a country expert to advise them on an Indian market entry strategy.
That makes a lot of sense. So to sum it up,
To sum up the control, in both non-discretionary and advisory services, the client is the most active in the critical decision-making. The discretionary model is the only truly hands-off experience for the investor.
and tying all three of these models together is maybe the single most important rule that separates PMS from almost everything else.
The pooling prohibition.
Exactly.
Absolutely. The rule is strict. It's unambiguous. Portfolio managers are not permitted to pool the money they collect from investors.
This is the bedrock of the whole individualized service idea, isn't it?
It is. Every client's funds have to be treated separately. If a PMS manages, say, 100 clients, they have to legally act as 100 individual agents. It stops the kind of risk contagion you might get if all the funds were mixed together. This rule is just crucial to maintaining that high fiduciary standard.
Okay, so we've seen the menu of services. Now we need to look at the gatekeepers.
Hmm.
Because of that high minimum investment and the trust involved in this fiduciary role, SEBI has built some really rigorous entry requirements. This whole section is about understanding why these hurdles exist.
It's really about weeding out instability and ensuring integrity from the get-go.
It all starts with the mandatory registration process.
Yes, obtaining a certificate of registration from SEBI under the portfolio manager's regulations is absolutely not optional. It's like a regulatory quality mark.
A stamp of approval.
Exactly. It signals that the company has been thoroughly vetted and has the financial capacity and the right people to handle client wealth responsibly.
And the application itself, it's not a simple form.
Oh no, it's an intensive process. The documentation has specific names in the rulebook, like Form A of Schedule 1. But what you really need to know is that this is a full-scale regulatory audit of the entire business.
So the applicant, which has to be a registered company, provides its identity, its financials.
And proves its corporate existence. But SEBI doesn't just look backward. They demand foresight.
What do you mean by that?
The applicant has to detail their complete organizational structure, prove they have adequate infrastructural facilities. That means secure office space, robust technology, the necessary manpower.
But the key foresight piece
Is the mandatory submission of a business plan for 3 years.
a 3-year business plan. That forces them to think about sustainability, growth, risk profiling.
And importantly, how they plan to handle client complaints. It stops, fly-by-night operators from just setting up shop.
And they need full financial transparency.
Total transparency. They detail their capital structure, net worth, where the resources are going, and their major sources of income.
It also extends to the legal side of things.
Yes, applicants have to disclose all settled and pending legal disputes. And even before they get registered, they have to submit a copy of the draft agreement with the client and the draft disclosure document.
So they have to prove their client-facing paperwork is compliant from day one.
From the very moment they might get that license.
This level of detail leads us right to the bedrock requirements for financial stability. SEBI mandates a minimum net worth of 5 crore rupees for the firm.
That 5 crore rupee benchmark is a serious financial anchor.
Why so high?
Well, it serves two main functions. First, it just demonstrates a serious commitment to the business. It ensures only well-capitalized companies enter the sector.
And the second?
More importantly, it provides a buffer. It's a guarantee of stability that helps assure investors that the firm isn't, reliant on their capital for its own operational survival. That financial muscle is needed to withstand market swings and operational costs.
And beyond just the money, SEBI looks at character. This brings us to the fit and proper norms.
Right. These are formalized criteria that focus on the integrity of the people running the organization.
So every applicant firm has to formally declare compliance with these norms.
Yes, and that involves some really rigorous background checks. SEBI specifically looks to make sure that the applicant or its key people have not been convicted for offenses involving moral turpitude or economic offenses.
What does moral turpitude actually mean in this context? It's a very formal phrase.
It is. It's not just about fraud. It's about a serious ethical failure that would fundamentally compromise an investor's trust.
So it's an encompassing term for serious wrongdoing.
Dishonesty, fraud, actions that show a deep lack of integrity. SEBI is basically saying that anyone managing large amounts of personalized wealth has to have a spotless ethical record.
And they also check for prior disciplinary actions.
Yes, against any connected person. So this dual check on financial stability and personal integrity ensures the people responsible for your wealth are trustworthy.
And the license, once it's granted.
The validity of the registration certificate is continuous, which means the firm has to uphold these standards indefinitely, or SEBI can suspend or cancel the license.
What's equally fascinating here is the sheer level of mandated personnel expertise. It's not enough to be rich. The managers have to be demonstrably qualified.
Absolutely. The regulation is very specific about the roles that need to be filled by qualified experts.
First up is the compliance officer.
Mandatory. The appointment of a compliance officer is a must. This person is the internal watchdog, making sure the firm adheres to every single rule and circular SEBI issues which are constantly changing.
And second, there's the principal officer.
The operational linchpin. This person is responsible for the overall function of the entire business. And SEBI sets the bar for this individual incredibly high.
What are the requirements?
It's a 3-part mandate. First, a serious professional qualification in finance, law, accountancy, or business management. That's the academic foundation.
Okay.
Second, and this is to ensure practical knowledge, they must have a minimum of 5 years of experience in related securities market activities,
Such as?
such as being an experienced fund manager, a senior stockbroker, or an investment advisor. Real-world experience.
And the third requirement.
That locks in their regulatory understanding. They have to hold the relevant NESM certification, which validates their grasp of the specific rules and mechanics of portfolio management in India.
So it's a tripod of qualification.
Mm.
Education, practical experience, and regulatory certification.
Exactly. And the firm also has to employ at least one other supporting person with a graduation degree and 2 years of relevant experience.
So the principal officer isn't operating in a vacuum.
No, it ensures there's some depth of expertise in the team that's supporting the client portfolios.
So if you put this all together, the 5 core net worth, the fit and proper norms, the 5 years of required experience for the principal officer.
It creates a really powerful filtration mechanism. The regulations make sure that only the most stable, most experienced, and ethically sound firms are allowed to offer these highly individualized wealth management services.
Okay, so we've passed the entry gate, and now we're in the operational reality. Once a PMS is registered and ready to manage assets, how does it actually handle your money? The core concept here is fiduciary duty.
That word fiduciary is absolutely critical. It means the manager must always act in a fiduciary capacity.
Which is the highest standard of care in law.
The highest. It means they are legally and ethically bound to act solely in the best financial interest of the client, even if that conflicts with their own profit motives.
And this relationship starts with the basic cost of admission for the client. This is a personalized, high-cost service, and SEBI enforces that. The minimum investment is 50 lakh rupees.
It's a major threshold, 50 lakh rupees, and it's a necessary one.
Why is that minimum so high?
Well, it's partly because running a customized, segregated PMS portfolio is administratively complex and expensive. If the minimum were much lower, the proportional admin fee would just become punitive for the investor.
So by setting a high minimum, the regulator ensures the service stays effective for high net worth individuals, or HNIs.
Right, for people whose capital warrants this level of customization and administrative burden.
And that fiduciary duty is enforced operationally through strict segregation. You mentioned earlier that pooling is prohibited. How does that translate to actual account management?
It translates to complete and total separation. The manager must segregate each client's entire holding, both their securities and their funds, into separate accounts.
So my stocks and bonds are in a distinct demat account in my name.
In your name, or in trust for you. Entirely separate from any other client's holdings, and, crucially, separate from the manager's own operational funds.
And what about cash?
All client funds must be kept in a separate account maintained in a scheduled commercial bank. This is a non-negotiable rule.
Why is this segregation so paramount?
Because it ensures that if the PMS firm itself were to face financial difficulties or even insolvency, the client's assets are completely ring-fenced and legally distinct. The manager's creditors can't touch the client's wealth.
That's a huge protection.
It is.
The regulations also place strict restrictions on conflicts of interest. If we connect this to the bigger picture, these rules ensure the manager can't benefit from the client relationship in any way outside of the fees we agreed on.
Exactly. The regulations are crystal clear on prohibited behaviors. Managers shall not derive any direct or indirect benefit out of a client's funds other than those pre-agreed fees.
And there's a major integrity check here.
Yeah.
The manager shall not borrow funds or securities on behalf of the client.
This is so important.
Why is that borrowing rule so critical?
It prevents undue leverage and risk creation. A manager can't just subject the client to high-interest debt to try and juice the returns in a risky way.
And they can't lend out my securities either.
Similarly, they cannot lend a client's securities to a third party for, temporary gain, except under very specific, highly restricted regulations. These rules just safeguard the capital and prevent the client's assets from being used as a balance sheet tool for the manager.
Okay, let's talk about the critical rule on self-dealing. The related party cap. Investment in the manager's own associates or related parties, say a real estate fund owned by the same parent company, is limited to a maximum of 30% of the client's portfolio.
This rule acknowledges that some degree of related party transactions might be unavoidable or maybe even strategic if the parent group has specialized knowledge, but the cap is there to prevent self-enrichment.
So the manager can't just use my capital primarily to fund their sister companies.
That's the idea. And the protection doesn't even end with the 30% limit. That transaction also requires one-time written consent from the client.
Ah, another transparency safeguard.
A major one. It ensures you, the client, are explicitly notified and agree that up to 30% of your portfolio could be routed back into the broader group ecosystem. Without that written consent, the investment is completely prohibited.
And beyond conflicts of interest, there's also a clear standard for asset quality.
Yes, portfolio managers shall not make investments in below investment grade securities.
Junk bonds.
Colloquially, yes, junk bonds. This is SEBI's way of saying that while PMS can offer custom, sometimes aggressive strategies, it's not a playground for extreme risk or highly illiquid assets. The mandate is for quality investments within a responsible framework.
And we should also note they have to comply with the RBI Act.
Yes, transactions in securities must specifically comply with the provisions of the Reserve Bank of India Act 1934. This just ensures they're adhering to the nation's broader banking and financial statutes.
Now, the burden of ensuring all these operational and ethical standards are met doesn't just fall on that one principal officer.
That's right. The senior management of the company bears the primary responsibility for ensuring appropriate standards of conduct and proper procedures.
So it's an organizational commitment.
Driven from the top down, and it's subject to regulatory scrutiny.
And that standard of conduct extends out into the marketplace.
It does. Managers have to ensure that any person involved in distributing or selling their services complies with all the regulations and circulars. This holds the firm accountable for the entire sales chain, making sure agents aren't out there misrepresenting the product.
And finally, grievance handling.
As a service provider, the manager is required to have a robust internal process for timely and proper handling of client complaints. Taking immediate appropriate action is mandatory. This mandated redressal loop is essential for maintaining investor trust.
Okay, we've established the stringent rules for who can operate and how they must operate. Now let's tackle the money everyone cares about, the fees. Navigating the cost structure in PMS can be the most challenging part for a new client, because it's often a mix of fixed costs and, well, complex variable incentives.
It can be, but the goal of the fee structure is to align the manager's incentive with the client's success, and that structure starts with the predictable parts.
The fixed costs. These are the management fees charged no matter how the portfolio performs.
Right. It's a fixed percentage, maybe 1 or 1.5% of the total amount being managed. This fee pays for the research, the people, the infrastructure.
And it's important to note the investor also bears the actual transaction costs.
Yes. Things like brokerage costs for buying and selling assets are charged based on the actual amounts incurred.
And how are those fixed fees calculated?
They're often charged on an average basis, the average of the initial capital contribution and the gross value of the portfolio over the period.
Why an average?
It prevents a manager from just charging the fee on a single high point if the portfolio value drops right after. It's a fairer way to do it. And of course, this is a service, so GST is applicable to all the charges.
We also have setup and exit costs. The setup fee is a one-time charge at the start.
Though competitive pressure often means this is nil or heavily reduced these days.
Right. Much more common is the exit load.
Yeah.
A fee, maybe around 2%, if an investor pulls their funds out before a specified period, like 1 to 3 years.
That mechanism is just there to encourage long-term commitment and penalize short-term churning that could destabilize the manager's strategy.
Okay, now for the variable part. The performance-linked fees.
The profit-sharing fees. These are additional incentives on top of the fixed fee designed to reward the manager for getting exceptional returns. And they're defined clearly in the PMS agreement you sign.
The crucial concept here is the hurdle rate. This is the non-negotiable, predetermined rate of return that the portfolio must exceed before the manager can charge any performance fee at all.
Think of it as a minimum benchmark. If the hurdle rate is, say, 8%, the client has to earn that 8% return in a financial year before the performance clock even starts ticking for the manager.
So it ensures the client gets at least a baseline return before they have to share any of the profits.
Exactly. If the portfolio only returns 5%, you still pay the fixed fee, but you pay 0 performance fee.
Why is this structure so necessary?
It separates passive returns, what you might have earned just holding a basic index fund, from the active returns generated by the manager's specific skill and strategy. You're only paying the performance fee for their ability to clear that hurdle.
So what does this all mean for the investor when the market, inevitably fluctuates? This is where the regulatory safeguards really shine. The most powerful mechanism here is the high watermark principle, HWM.
This is a phenomenal protection mechanism. The HWM dictates that performance fees are calculated only on the gains when the portfolio value exceeds the previous highest value at which performance fees were paid.
So it completely safeguards the investor from paying fees for just recovering losses.
Completely.
Okay, let's run a simple hypothetical scenario to really cement this in the listener's mind, because this is so often misunderstood.
Agreed. Let's imagine you invest 100 lakh rupees.
Okay.
In year one, the portfolio grows to 120 lakh. The manager hits a new high watermark 120 lakh and charges a performance fee on that 20 lakh gain, assuming they cleared the hurdle.
Makes sense. Then in year two, the market crashes, and my portfolio value drops to 90 lakh.
Right. And then in year three, the market recovers, and the portfolio goes from 90 lakh back up to 110 lakh.
Okay, so in year three, my portfolio gained 20 lakh from its low point. Does the manager get to charge a performance fee on that 20 lakh gain?
Absolutely not. And this is the key. The manager's gain of 20 lakh only brought the portfolio to 110 lakh, which is still below the previous high watermark of 120 lakh that was set back in year one.
So until the portfolio crosses 120 lakh again.
They cannot charge a performance fee. They're being forced to work for free, essentially, to first recoup your losses. It ensures you only ever pay for new profits.
That makes the high watermark principle so essential for long-term investing. You're protected from that nightmare scenario of paying fees over and over again for gains that just bring you back to where you started.
Right. And building on the HWM, there are two variations on how the actual calculation is done once you've crossed both the hurdle rate and the high watermark.
Catch-up versus no catch-up.
Exactly.
The catch-up concept means that once the portfolio clears the hurdle rate, let's stick with our 8% example, the manager then calculates their share of the performance fees on the total earnings, starting from the very first rupee of profit.
Right. So they effectively catch up on the fees they didn't get to charge on that initial 8% threshold.
And the no catch-up concept.
That is, conversely, significantly better for the investor. It means the manager only calculates their share on the incremental amount earned above the hurdle rate. The client keeps that first 8% of the return completely free of performance fees.
So the manager only shares in the excess returns they generated through superior skill. So we have to explicitly state what the source material indicates. No catch-up is generally better for the investor. It limits fees strictly to those excess returns, and it maximizes your net gain. When you're reviewing a PMS agreement, this is one of the key differentiators to look for.
Absolutely.
Okay, we've covered the rules, the roles, and the costs. The thread connecting all these elements is transparency, because you're entrusting a manager with such a high level of capital and control. SEBI requires rigorous disclosure at every single step.
And that transparency starts with the legal basis. A portfolio manager must enter into an agreement in writing with the client before taking on the assignment.
And that contract defines the scope, the investment approach, and locks down that fee structure we just talked about.
Exactly. But the core document for the client is the disclosure document. This has to be provided to you, the client, before you sign anything.
And it contains all the specifics, the quantum and manner of fee payments.
But it's more than just a financial statement. It's a risk guide. This document must include portfolio risks specific to each investment approach.
Which is essential. A concentrated small-cap value strategy has wildly different risks than a diversified bond strategy, even if they're run by the same firm.
The disclosure has to be granular enough for you to truly understand what you're signing up for.
And SEBI demands consistency in communication.
They do. This forces managers to report their performance uniformly, whether it's in disclosures to SEBI, in their marketing brochures, in reports to clients, or on their website.
So no firm can use inflated or misleading performance figures to lure in prospects.
What they show the regulator must be what they show you. And any related party disclosures must follow the strict accounting standards issued by the Institute of Chartered Accountants of India. It just adds another layer of auditable protection against potential conflicts.
Okay, moving to cost optimization. There's a vital facility that PMS providers must offer that can directly reduce the cost for the investor.
The Direct Access Facility.
This is a major consumer mandate, designed to empower the H&I investor.
It is. It allows you to go directly to the service provider, completely bypassing an intermediary like a traditional broker or distributor.
And the main tangible benefit is increased net returns.
That's right. Because the commissions normally paid to those intermediaries are eliminated, you cut out the middleman's fee, which directly lowers your total expenses.
It's important to clarify, though, that the actual management of the funds doesn't differ.
Not at all. The investment strategy, the principal officer, the expertise, it's all identical. The difference is purely in the distribution channel and the resulting fee structure. It's often called the do-it-yourself approach for the paperwork, but not for the investment decisions themselves.
So if you can go direct and save money, why would you ever engage an investment advisor, an IA? Their role under the regulations is very specific, isn't it?
It is. It's strictly about guidance and suitability assessment. The IA acts as an impartial guide.
So they help the investor evaluate if PMS is even necessary for them.
Exactly, given that high minimum threshold. They are crucial in evaluating the suitability of the direct access facility to help the client save costs. They also guide the client on which service type, discretionary versus non-discretionary, best fits their personal activity level and risk tolerance.
So the IA gives you the map and the compass, but their involvement stops at the decision.
Yes. Implementation services offered by the investment advisor are not mandatory. The client is under no obligation to use execution services from the IA.
And SEBI formalizes this separation with strict rules.
Very strict rules to eliminate conflicts of interest. An individual investment advisor has to choose. They can register as an advisor who charges a fee for advice, or a distributor who earns commissions for selling products. But they cannot undertake both activities.
And the firewall.
It is. And if they advise you, their family or affiliated companies also cannot charge implementation fees from you. It ensures the advice you're getting is genuinely unbiased and focused purely on your needs, not influenced by potential sales commissions.
This clear separation of roles, advice versus distribution, is central to protecting the client from conflicted guidance. Wow, that was a serious deep dive into the regulatory heart of portfolio management services. Let's bring it all back together for you.
We established that PMS, which has been regulated since 1993, is really built on a foundation of fiduciary duty. It demands high integrity and financial stability from these firms.
Right. The barrier to entry for the firm is that 5 crore rupee net worth, and for the client, a minimum investment of 50 lakh rupees.
We clarified the difference between those 3 customized service models. Discretionary.
Where the manager acts entirely on your behalf.
Non-discretionary.
Where the client maintains that final decision veto.
And advisory, where the manager only provides the research and ideas. And we stressed that no pooling of client funds is ever allowed.
We also dissected that complex cost structure, confirming that while you always pay a fixed management fee, the incentive fee is protected by 2 key mechanisms.
The hurdle rate, which ensures you get a baseline return first, and that powerful high watermark principle, which prevents you from paying performance fees on gains that are just recouping prior losses.
And we confirmed that the no catch-up method is generally the most beneficial for limiting those fees to pure excess returns.
Exactly.
And finally, we discussed the mandatory transparency mechanisms, like the disclosure document, which has to outline risks specific to the investment approach, and the requirement for providers to offer that direct access facility for cost savings.
You know, our entire discussion has really centered heavily on what the manager must disclose to you to comply with SEBI, the fees, the performance, and specifically portfolio risks specific to each investment approach. The regulation demands that granular level of detail.
Right.
And given that the regulation demands such granular, uniform disclosure of highly specific risks tailored to niche investment approaches, say, the specific liquidity risk inherent in a concentrated small-cap strategy, it really requires an equally informed response from the client. So the closing thought for you is this. What practical steps should you take, beyond just reading the agreement, to fully evaluate whether that specifically disclosed risk profile, which might be highly specific to a niche investment approach, aligns with your overall long-term financial philosophy, especially since the regulations demand such granular, uniform disclosure?
That's the critical link between regulatory compliance and your own personal due diligence. Thank you for joining us for this deep dive into portfolio management services.
Until next time.